For over a decade, bonds were the boring cousin at the investing table. Low yields, flat returns, the asset class everyone held out of obligation, not excitement. That's changed. In 2026, fixed income isn't just back. It's one of the most talked about corners of the market. So what happened? And why are investors, from pension funds to everyday savers, suddenly paying attention again? To understand the comeback, you need the backstory. For most of the 2010s, interest rates sat near zero. That meant bond yields, the income investors earned for lending money, were painfully thin. A 10-year US Treasury might pay you 2% a year, barely enough to outpace inflation, let alone build wealth. Then came the rate hikes of the early 2020s. The Federal Reserve, fighting inflation, pushed rates sharply higher. Bond prices, which move opposite to yields, took a hit. Investors who had gotten used to safe bonds suddenly watched them lose value too. It was a rough stretch, but it planted the seeds for what's happening now. Here's the twist. Those painful rate hikes left something valuable behind: yield. Today, benchmark Treasury yields sit meaningfully higher than they did for most of the last 15 years. And that changes the entire risk-reward equation for bond investors. Financial professionals describe it with a simple example. Say a bond yields 4%. If interest rates climb another point, the bond's price might dip around 6%, but you're still collecting that 4% income. Net result: a modest 2% loss. Fully manageable. But if rates fall by a point instead, that same bond's price could rise 6%. Add your 4% income, and you're looking at a 10% gain. That's an asymmetric bet worth making. Income is doing more of the work now, cushioning investors against the ups and downs that used to make bonds so unforgiving. It's also why major asset managers are calling this one of the best income opportunities fixed income has offered in over a decade. But this isn't a story of buy any bond and relax. 2026 environment rewards selectivity. Inflation remains a bit sticky. The Federal Reserve is proceeding cautiously rather than cutting aggressively. And the yield curve, the relationship between short and long-term rates, has been steepening, meaning longer-dated bonds carry more risk than they used to. That's pushed many investors toward the middle of the curve, bonds maturing in roughly 4 to 10 years, where they can capture strong income without betting too heavily on where long-term rates end up. Investment-grade corporate bonds are also drawing interest. Company balance sheets are largely healthy, and while the extra yield they pay over treasuries is historically low, the underlying credit quality gives investors confidence. High-yield bonds and municipal bonds are getting attention too, for investors willing to take on a bit more risk or who want tax advantages. The common thread: this is a market for active decision-making, not passive autopilot. Zoom out, and bonds are reclaiming a role they'd lost as genuine ballast in a portfolio. For years, low yields meant bonds barely dented volatility during stock market swings. Now, with real income back in the picture, fixed income can once again do double duty, generating steady cash flow while helping smooth out the bumps when equities get shaky. There's also a longer-term case. Some major forecasters now project global bonds could deliver solid annualized returns over the next decade, a meaningful upgrade from the near-zero yield years. That's a big reason financial advisors are telling clients, don't overlook this asset class just because it was underwhelming in the past. So, is fixed income safe again? Not without nuance. Rates, inflation, and credit conditions can all still shift the picture. But after years in the wilderness, bonds are once again offering what they were always meant to: reliable income, portfolio stability, and a genuine seat at the table. Whether you're a retiree seeking steady cash flow or a younger investor rethinking diversification, understanding why fixed income is regaining trust could shape smarter decisions for the years ahead. If you found this breakdown useful, subscribe for more clear, no-nonsense market explainers and drop a comment. Are you adding bonds back into your portfolio this year?